You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Lingering issues in China's property market have sparked concerns that China's last few decades of remarkable economic growth could soon plateau. Consistent investment premised on eternally rising property values have distorted affordability and led to an overheating real estate market. The Chinese government has enacted policies that aim to both curb speculative bubbles as well as support demand to help instill confidence in the housing sector. On today's episode, we talk with Kristy Hung, Senior Analyst for China Real Estate with Bloomberg Intelligence, about how to understand China's real estate sector, what caused the problems at Evergrande and Country Garden, and how all of this could impact global investors. Stay tuned. Coming up soon, our interview with Kristy Hung, but first, a quick market update. Yesterday's June CPI came in much cooler than expected, following up the very encouraging 0.16% increase in the May core CPI to suggest that high Q1 inflation will not repeat. The 0.1% decline in the headline index for June and the meager 0.1% increase in the core should lock in a September rate cut and increases the probability of a second cut by the end of this year. Before the September meeting, the Fed will see 2 more months of CPI data. Payrolls growth for June came in mostly as expected last week, but downward revisions to the previous 2 months and the uptick in the unemployment rate to 4.1% give more signs that the labor market has come into better balance. In Chair Powell's testimony in front of Congress this week, he said that the labor market was no longer overheating and emphasized that high inflation is not the only risk that monetary policymakers face right now. His comments confirmed what financial markets had largely priced in, but were interpreted through a dovish lens ahead of yesterday's CPI. Treasuries rallied through the various data reports in Chair Powell's testimony the last couple of weeks, with yields falling across the curve to levels not seen since late March. This helped most securities break out of established narrow ranges that had persisted through most of June. Yields on 2-year treasuries tested 4.5% after the CPI release, while 10s broke through 4.2%. We expect fixed income assets to maintain these gains over the next few weeks when the June PCE release solidifies Q2 disinflation. President Biden's weak performance in the presidential debate almost 2 weeks ago has increased calls for him to leave the ticket, though he insists he is not dropping out and is capable of serving another 4-year term. Treasuries had sold off the first 2 trading sessions following the debate, which many interpreted as a market reaction to the higher probability that Donald Trump will win the White House and enact policies that widen the deficit and increase longer-term inflation. The second round of French elections ended earlier this week with no clear winner. None of the 3 broad coalitions won enough seats to govern on their own, so there's still some uncertainty with how the dust will settle. The far-right National Party underperformed expectations, but the real surprise was that a far-left coalition won the most seats. Financial markets worry that both the far-left and far-right would push for policies that would expand France's fiscal deficits. That's all for the market update this time. Now our interview with Kristy Hung. Our guest today is Kristy Hung, Senior Analyst for China Real Estate with Bloomberg Intelligence. Kristy, thanks for coming on the podcast.
My pleasure. Thanks for inviting us.
Our topic today is the Chinese real estate market, how it fits into the overall Chinese economy, and what could be in store for the future. So I think that, like most of our listeners, I have a lot more knowledge of the U.S. economy and housing market than that of China. So in the U.S., the government does play a role in real estate through things like public housing, some deductions in the tax code, Fannie Mae and Freddie Mac. But overall, building decisions and ownership of residential real estate is mostly in the hands of the private sector. Kristy, in China, what is the government's level of involvement with choosing what and where to build and the ownership of real estate?
Right. So China real estate sector is a highly regulated sector. The government is involved from the very beginning, from, land supply decisions to up to the point when developers have to launch new projects for sale. It can't be done without the approval from local governments. For example, a project has to be launch for approval, the local government would be there to grant the approval as well as to guide the average selling price of every project in the country. And ever since, 2018, there has been signs of overheating of the housing market. And the government has been introducing, for example, curbing the access of financing for developers, say restricting the sales of offshore or onshore bonds, as well as access to bank lending. And also on the demand side, the government has been trying to introduce curbs like, home purchase restrictions. Say in China, it's not a free market in the past few years, as in if I like to buy a home, I can buy as many as I wish. Say, for example, if someone would like to buy a home in Beijing, you either have to have a residence permit in Beijing, or you have to provide some kind of proof. For example, I have to provide 5 years of tax payment or social security payment in the city in order to qualify to buy a home. And then there's also measures like down payment ratios or lock-up period. Say, if I bought a home, it's not like I can sell it anytime as I wish. Some cities have lock-up period of 3 to 5 years. So these are measures to try to restrict demand during the housing boom. And I think the very last straw was the 3 red line rules. That happened around 2020. The government has introduced these 3 red line rules for developers, restricting their net debt to equity ratios, cash coverage of short-term debt, as well as liability to asset ratio. That prompted developers like Evergrande the need to quickly deleverage the balance sheets, and that actually led to the liquidity pressure for a lot of developers, and most notably Evergrande, and which started the whole property crisis. So I think it's fair to say that throughout the housing boom as well as the bust in China in the recent years, the government has been heavily involved with very strict intervention of the market.
So that's really interesting. It does sound like the government has a much higher involvement than we're used to in the U.S. or parts of Europe. And what is the thinking behind all of those kind of financial parameters, kind of restrictions or limits, things to stop people from becoming too leveraged? Because, of course, in a kind of idealistic textbook market system, private buyers, private lenders, they take the risks, and so they have the rewards. Is there some implicit guarantee from the Chinese government where buyers or developers were starting to act too risky?
Yeah, so I think it started from 2015 when Chinese developers have access to the onshore bond market, and they managed to raise a lot of capital, and a lot of those capital went into the land market in China, and that started to bid up land prices. And during 2016 to 2021, that was the housing boom in China. And there has been soaring home prices in some cities like Nanjing, Suzhou, Hefei, and Xiamen. These cities, home price rose, I think I remember it's about 40% in one single year. And the home price increase has sustained up to 2021. And throughout the process, the government has been doing many things that I've talked about just now to try to cool down the market, but it hasn't been successful. Like even curbing developers' access to financing or demand side measures for home buyers. I think the 3 red lines was the very last straw for the government to try to regulate the market, to try to cool down the market so that home prices would cool down and housing could be affordable, because the home price increase, the ramp up of that in those years has started making housing unaffordable in China. And this is, I think, one of the rationale behind the regulations.
That's sort of hot money, of course. It should be clear, it does exist in more market-based systems. Vancouver, the Bay Area, of course, there are overheating housing markets, even when the government is not playing too much of a distortionary role. Now, China has had a tremendous amount of economic growth over the last 30 or so years. And I know you talked about the real estate market since 2015, but even before then, real estate seemed to be playing a huge part in that narrative of just tremendous growth the last few decades. How much of that growth has been driven by investment in real estate? And has real estate's share of the overall economy changed over that time, or is it pretty consistent?
Right. So if I would just quote one statistic. If you look at China's new home sales by floor area in the past 2 decades, 47% of which were sold during 2016 to 2021. So the last stretch in the 6 years of housing boom that we saw, it sold 47% of all floor areas sold in the past 2 decades. And I think that shows you the concentration of home buying activity or construction activity that power the economy. And I think this housing boom was very driven by households' expectation of home price increase because home prices rose 4 to 11% a year during the period. So you see the good return, and it almost seems like housing was a one-way bet in China, and property investment became a religion almost in China. People were buying the second, the third, the fourth homes, not to live in, but just as an avenue to park their investments. They left their homes empty, they wait for capital appreciation, and there you go. There's also, if you talk about the impact on the economy, it's not only restricted to the real estate sector, but also there's wealth effect on consumption. Home prices rose, the value of the wealth increased, people feel good about themselves, they go out and spend. And therefore, it has been tremendous in its impact on the overall economy. If I look at real estate investment in China, at the peak of the housing boom, which is 2021, it accounted for 13% of China's GDP. If compares to 5% in the US in 2007. In China, 90% of real estate investment comes from the residential sector. So it's a big driver of China's economy. And if I look at, related upstream or downstream demand, for example, raw materials, construction, white goods, you see that property and the related sector, a lot of estimates were made. It made up around 20 to 25% of China's GDP. So it has a big impact. And therefore, the boom as well as the bust is going to have a good ramification on the overall economy.
I think that puts it into really helpful context because a lot of people that I talk to can often be surprised that real estate is a relatively small share of the U.S. economy, but of course its connection to the financial sector is what allows for that contagion and for it to spread into the wider economy. And it sounds like what you described of people investing, not in a entirely speculative way, but really putting money into these homes not because they get utility out of living in them, but just because there's this assumption that asset prices will keep going up. And of course, if 2007, 2008 showed anything to the world, that's true until it is not. So now, in the last few years, you did talk about Evergrande. And so we've heard about distress at real estate companies like Evergrande and Country Garden. Can you tell us about what happened to these companies and the circumstances that led to the distress? What sort of caused a tipping point for these developers to suddenly kind of have trouble making bond payments and potentially even declare bankruptcy?
Right. So I would say Evergrande and Country Garden stories, they're very different. They're at one point, the two largest developers in China by contractor sales. And I think for Evergrande, I would call it self-inflicted pain. Its net debt to equity at one point was over 200%. It's the most indebted developer globally. And the developer has always used leverage to try and expand its land bank in order to expand its top line and earnings growth. It came to a point when it's unsustainable when the government started introducing rules like 3 red lines to prompt them to deleverage, and that immediately led to cash flow issues for the developer in mid-2021. Country Garden was very different. For Country Garden, it failed to pay its coupon payment in August 2023. So the crisis has been running for over 2 years. If I look at private dollar bond issuers of the real estate space in China, around 2/3 of them is already defaulted. So that shows you the pain in the industry that has spread to then even higher quality names like Country Garden. And it also comes from how, because of Evergrande's default and many other developers, Chinese home buyers have started questioning whether it's safe to buy new homes from developers. And, contractor sales, which is pre-sales for Chinese developers, is the lifeblood of their liquidity. So when home buyers stop buying new homes or pre-sale homes from developers that really restricted the liquidity, and the crash in the sales as well as the liquidity led to Country Garden's default. I would say is the pain in the industry that is so deep that started hurting high quality names like Country Garden.
And so, where do things stand now with those companies or the overall Chinese real estate sector? Maybe some other companies that we didn't talk about. Are there risks of wider economic contagion? Does it feel like the dust has settled? And what was the government's response to this? Did they feel like these companies were too big to fail, or did they want to have them experience suffering as a way of market accountability for being too leveraged and taking too big of risks?
So I think one of our bigger concern would be potential systemic risks in the banking sector. So it hasn't shown up so far. If you look at Chinese banks, their non-performing loans ratios are still quite low. But if you look at, the price to book ratios for Chinese banks versus others in Asia, it appears as, investors are having questions over those low NPL ratios. And I think it also comes to a point, which is a question when, these mortgages are still being surfaced for homes that aren't yet completed. Because I've talked about how property sales in China, they are mostly on a pre-sales basis. 90% of new home sales are pre-sales. It means that home buyers, they need to pay 100% upfront for properties that will be delivered in 2 to 3 years, and there's no consumer protection. If the developer defaulted, it no longer has cash flow to complete the construction. We see the examples of, store housing projects in China that is nowhere being completed. If this phenomenon continue, and I think at one point homeowners will start questioning, why am I still paying for my mortgage that, for a home that wouldn't be completed. And this has triggered a mortgage boycott in mid-2022. And with government pressure, the protest has died down. But I think if this problem persists, that there could be questions from home buyers and down the road as well. And from the government, I would say that, you're right in saying that the government has allowed a lot of developers to bankrupt. In mid-2021, since Evergrande's debacle up till end 2022, we saw a wave of private developers defaulting on their debts. So it has allowed this to happen up to a point. I think it started to realize that, okay, the damage to confidence is being done and we need to start doing something. So the first round of more significant bailout was in late 2022, the 16 points. And then after Country Garden's missed payment, there's another round of stimulus measures in September 2023, and then in January 2024, earlier this year, as well as just last month, May 2024. So I think there has been 4 rounds of more substantial efforts from the government to try to revive the housing sector. I think the government is taking it seriously now, but I will also say that, we have already 4 rounds of stimulus measures. And the more that is being implemented, the danger is that there's actually limited ammunition left in the government's policy toolbox. So if I would quote an example, down payment ratios in China, just in May, the minimum down payment ratio is being lowered to 15%. The mortgage rate for first homes is, on average being lowered to 3.45%. So there is actually quite limited room to further reduce those in order to revive demand.
That brings up a few interesting points. Just so I have this clear, I mean, it sounds like it is a recipe for a kind of asset depreciation spiral where people are speculating in these properties because they feel like it's a good investment and it keeps going up in this sort of mania. And when that stops and people aren't so confident in that, well, then it becomes a self-fulfilling prophecy. But also, if I understand correctly, people would take out a mortgage and be responsible for it for a property that wasn't completed yet. And if the developer goes bankrupt and that house doesn't exist, people are still on the hook for that mortgage?
Yes, and I think the different things in China is that you have that social credit rating system. So in China, it's not like an individual can just declare bankruptcy and walk away from the mortgage. In China, the mortgage is always with you for your whole lifetime. And if you have issues in your social credit rating, you won't be able to access certain things in the welfare system, or you won't even have the access to buy train tickets, for example. That's why in China, your mortgage debt is not something that you can walk away from easily.
But also, it sounds like in this situation, the way that the government is trying to make sure that there is some housing demand to maybe stop that downward momentum of asset prices is to lower the down payment ratio and lower mortgage rates as a way to ease demand. But doesn't that kind of just create more fragility? I mean, I understand the thinking behind it, but does it solve the problem as much as just kick the problem down the road because now people are even more levered?
Yeah, so um, since late 2022, the government has been very focused on demand side measures that you mentioned, lowering mortgage rates, lowering down payment ratios, as well as relaxing a lot of the home purchase restrictions that I mentioned. Like, for example, if I like to buy a home in Hangzhou now, which is the headquarters of Alibaba, anyone can buy now. You no longer need a residence permit in that city, or you no longer have to have experience working in that city. So we see that there's been a wave of these relaxations or stimulus measures to try and prop up the sector. These measures worked in 2015 and 2009. These measures prompted V-shaped recovery in the housing market, whether it's from sales volume or home prices. But up to the point in 2022, these measures are not working anymore. And I think it coincided with other risks in the economy. I think with these demand side measures, it doesn't matter how much the government is trying to make it easier for people to buy a home. That's not overcoming a lack of confidence. There's a lack of confidence in people's jobs, their income. If I don't think that my income is secure, how do I commit myself in buying a property and servicing mortgages every month? And also, there's also a sharp change in home price expectation in the country. As I said, in 2016 to 2021, home prices rose 4 to 11% per year. And it's, the only way is up. And after Evergrande's crisis, to Chinese people, it feels as if, the only way for home prices to go is down. So that also prompted a lot of home buyers to, stay away from housing investments. So they will look into other areas like, for example, mutual funds or insurance policy or even deposits as, safer way to preserve their wealth. So I think these are the factors that are still posing roadblocks to a recovery in the housing market. And in addition to that, we're also seeing leakages of demand from the new homes market to the second-hand home market because people are worrying about whether these pre-sold homes will be completed. They're going into the second-hand home market because what I see is what I get. They would buy second-hand homes because the discounts are normally steeper, as well as the fact that there's certainty of property delivery. So even when these demand side measures are being introduced, second-hand homes might see a stronger pickup than new homes. That's why the contractor sales or the liquidity from developers is not having a big benefit as they should be.
So I see that there can be two main impacts from all of this situation, this crisis on global investors, and the first one is through direct financial exposure. So, do you have a sense of what kind of exposure global investors, American investors, have to Chinese real estate? Are Americans allowed to own homes? Do they purchase these bonds? What can we tell for how much this distress is going to trickle out of China and into the broader global economy?
In terms of home buyers, China's property market is very much a domestic market, catering to just Chinese people. There's a bit of foreign investment, but that's really not significant. And in terms of, in equity or fixed income space, I would have to say that, the foreign funds that I've spoken to, since a few years ago, many of them have started becoming ex-China or even ex-Hong Kong. So I think foreign funds, they're no longer a big player in the China property space. And that is due to obviously geopolitical risk. And I think there's also in the market recently, there's also, genuine concern on the fundamentals for China's property sector. There's oversupply, whether it's in the residential or the commercial real estate space, especially for offices. So these factors are keeping investors at bay. So I would say that investment and the potential repercussion in the global economy could be very limited. But China property being called one of the most important sector in the universe in the past because of the linkages to other sectors, I would say that the wealth effect on consumption will still be notable. The wealth effect that on consumption that would affect consumer or e-commerce players. And a lot of these are global names or listed in the US. And also there's also suppliers for Chinese homes. If I look at elevator companies or white goods or even bathroom fixtures, a lot of these are global players that have a big exposure in the China housing market, and their business would be impacted.
So that leads me to where I see the second biggest impact on global investors, which is just to the extent that it slows Chinese growth. And do you feel like this is going to cause an inflection point in how the government is viewing the role that real estate investment plays in the overall economy? Do we have a different projection for the growth rate in China's GDP over the next 10 or so years, now that this correction seems to be happening, since it seems like 2021, where maybe that heat needs to moderate a bit? What do you see in terms of the impacts on China's growth from what this real estate crisis has exposed?
Right. I think from a policy makers standpoint, they have come to that inflection point in late 2022 when, they weren't very serious about supporting the sector to, end 2022. They are really serious about, trying to revive the housing market in China. But I think, up to that point, China has undergone, 1.5 years of corrections in the housing market, and a lot of the damages to confidence are already being done. And that's why those property support packages are not working so well, which is still the case nowadays. So I think we had 3 years of property crisis in China. The government is very serious about reviving the sector, but it's just that home sales is really not showing the effect of the property measures. So I think when it comes to the home sales in China, I think we're not close to an inflection point yet. Even if we are going to reach the inflection point, later this year or 2025, I think that the recovery that you will see from that is not going to be a V-shaped recovery that we have seen in 2009 or 2015, but rather it will be an L-shaped recovery, which is suggesting prolonged stagnation for the sector. And, what is different this time is, there is serious structural problems in the property sector in China, when it comes to oversupply of property, that's going to impact home price expectation of households. So as long as households don't think that home prices are going to pick up, they're not going to get in the game of investing in property. And thinking about property investments, which is buying your second, your third, or fourth homes in China, this could have accounted for around 40% of new home transactions during the housing boom in 2016, 2021. So then coupled with that, you also have structural problems coming from a demographic crisis in China. If you look at marriages and birth rates, they are at record low level. So these are going to hamper household formations, and also these are going to hamper demand for first homes as well as upgrade. And, along with these, there's the lack of confidence on jobs and income that I've mentioned. If we look at a survey being done by one of the largest recruiters in China, a survey on white-collar workers, 57% of white-collar workers are worried about losing their job in 2024. That shows you the low confidence among Chinese households. I think that, for things to pick up again, we do need to see, pick up in the overall economy, meaning that we need to see a few quarters of better than expected economic data for people to have the confidence in thinking that, okay, the economy is recovering, my employment prospect is recovering, the home price prospect is recovering. Then they will have to start to have the appetite in property investments again. And in addition to that, I talked about the leakage demand from the new home to the second-hand home market. So all these added together, we do see that more challenges that we're facing at this point versus the past down cycles. So I think that's why we're saying, even if the inflection point is to come, we expect the path of recovery would be more slow paced than the past down cycles. Or, if I compare that to the US, I think it took around 17 years for home sales to recover to its pre-crisis level in 2005. And for China, our view is that home sales would never get back to pre-crisis level in 2021.
I want to end with a question about looking to the future. So in the U.S., data on commercial real estate, especially, can be quite opaque for a number of reasons, and also housing and real estate can be so local or regional. And so taking the pulse of the housing market and figuring out where the areas of distress are can be a little bit more complicated than when you just are looking at national numbers. So when you track the Chinese real estate market, what are the indicators that you look at closely to gauge the overall health and stability of the Chinese real estate market? So for a lot of the things that we've been talking about today, what do you think are a handful of important things that people can follow to track the progress of how things are going?
Right. I think one of the biggest indicator would be developers' ability to fund themselves. So since the crisis, developers have not been issuing bonds offshore, and they have very limited access to the onshore bond market. It's mainly limited to a few state-owned players. So I think you need to start to be able to see that developers have that access to funding so that they can kickstart the investment process again. And the second thing would be land investments. So it used to be the case that land investment is constituted of, about 2/3 coming from the private sector. But because of developers' defaults, they are no longer having the cash flow to buy land. So we see that, there's such a big slump in land investment in China that the authorities have stopped disclosing the land sales numbers. So I think we do have to see, developers having the confidence in investing in land and buying new projects again, so that we would start to also see, a pickup in buyer confidence. And I think if you are looking for an indicator for a pickup in new home sales, in the 2009 and 2015 cycle, when there's a pickup, it always starts first in tier 1 cities, which is Beijing, Shanghai, Guangzhou, Shenzhen. So if we are starting to see a more sustainable recovery in these 4 cities, gradually this stronger sentiment is going to spread to then the stronger tier 2 cities like Hangzhou, Chengdu, and then the weaker tier 2 cities as well. So, but I think it used to be the case that pickup in new home sales will also spread to smaller low tier cities in China. But after this correction, a recovery in low tier cities in China could be more difficult.
Kristy Hung, thank you for coming on the podcast.
Thanks for having us.
That was Kristy Hung, Senior Analyst for China Real Estate with Bloomberg Intelligence. What stands out to me from that interview is how much the investment in Chinese real estate has come from speculative forces. People have bought second, third, or fourth homes in a speculative mania that has little to do with actually deriving use of the housing. Chinese citizens are also on the hook for the mortgages attached to homes that don't exist and will never get built. Even though the exposure to American investors appears limited for now, the performance of the second largest global economy will of course have downstream impacts on the United States. Next Tuesday, June retail spending data will be the last big Q2 personal consumption input before the second quarter GDP release the following week. After a weak headline reading in Q1 and some uninspiring data thus far for Q2, investors will be looking for more evidence of an economic slowdown. The Atlanta Fed's GDP Now model currently estimates the economy grew 2% last quarter. The June PCE will be released on July 26th, giving a final inflation reading before the Fed's July 31st policy decision. Although we think a rate cut at the end of this month is unlikely, the CPI this week does point to another encouraging print in the core PCE deflator that will help shape the tone of the FOMC statement and Powell's press conference as financial markets look ahead to the September meeting. A number of Fed officials are scheduled to speak next week before the customary pre-meeting silent period begins the evening of Friday, July 19th. FOMC participants will have an opportunity to add color to Chair Powell's testimony from this week and let the public know if the June CPI has changed their outlook on inflation or monetary policy. Also next week, the Fed's latest beige book will be released Wednesday afternoon. That's all for today's episode. Thanks again for listening. I'm Will Comperl, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.